$429,361,000. I mean, if you had that much cash sitting in your bank account right now, you'd probably feel pretty untouchable, right? But the question we're asking today is actually this. How long does it take an ambitious space technology company to burn through nearly $500 million? Let's find out.
Welcome to the EDGAR brief. Today, we're cracking open the Q1 2026 10Q filing from Voyager Technologies. That's ticker symbol VOYG, filed for the period ending March 31st, 2026. Our mission here is simple. We're taking this dense, accountant-speak SEC filing and translating it into plain English. Quick note before we jump in. We are an independent AI-assisted explainer. We're not affiliated with the SEC, and we are absolutely not financial advisors. We use AI to help summarize this stuff, so, errors can happen. Always verify the numbers yourself on sec.gov before making any actual money decisions. All right, let's get to work.
Section 1. The business model. We always like to start with the most basic question. What exactly does this company do, and how do dollars actually walk in the door? Well, Voyager's business model is really a tale of two completely different realities. You've got what pays the bills today versus what they hope will turn them into giants tomorrow. Think of Voyager kind of like a high-end construction company that just decided to build a multi-billion-dollar luxury hotel out in the middle of the ocean. That's their Starlab space station project. It's incredibly expensive, it currently generates exactly zero revenue, and man, it burns cash like a furnace. But to actually pay the bills while they build this crazy ocean hotel, they do highly specialized mission-critical plumbing and electrical jobs for the U.S. Navy. That's their defense and space technology segment. It's real, it works, and it brings in the cash today. So basically, they're a government contractor funding a massive sci-fi dream.
So who's actually writing the checks for this specialized work? Out of their $35.2 million in total quarterly net sales, the U.S. government is overwhelmingly their biggest customer. They brought in $29.6 million this quarter alone. Commercial clients chip in, about $5.5 million, and international government sales are literally just a blip at around $100,000. To put it simply, Voyager is effectively a highly specialized contractor for Uncle Sam.
Section 2. The financial scorecard.
Let's leave the sci-fi excitement at the door for a second and look at the actual numbers. Are more dollars staying inside the building? Frankly, the math on this scorecard is pretty brutal. Over the last year, Voyager's revenue, the actual money walking in the door, barely ticked up by 2.1% to $35.2 million. But their cost of sales, the raw materials, the labor, the parts needed to actually deliver those goods, that exploded by 27.2%, up to $36.7 million. Because their costs grew so much faster than their sales, their gross margin was completely destroyed. They actually lost $1.5 million before even paying their corporate staff or keeping the lights on at headquarters. So why did this happen?
The answer is hidden in two little words: fixed price. A firm fixed price contract is an agreement where the sale price is locked in on day one. Think of it like catering a wedding. You quote the bride $50 a plate, right? A year in advance. But if the price of chicken and your staff's wages suddenly triples by the wedding day, you still only get $50. You have to eat that loss. Well, in Q1, Voyager had over $18 million in fixed-price sales, and the cost to fulfill those specific contracts just surged. And this brilliantly illustrates exactly why we have to look at free cash flow. Look, accounting profits can be manipulated with clever depreciation schedules, but cash is real. Free cash flow is simply the actual cash left over after the business runs and pays for its necessary equipment. For Voyager this quarter, negative $66.7 million. Nearly $67 million in real cash walked out the door in just 3 months. Remember that $429 million cash pile we started the explainer with? At this burn rate, that pile shrinks very, very fast.
Section 3. The moat check.
Okay, so things are expensive, but what protects Voyager from being crushed by a bigger competitor tomorrow? What are their durable advantages? Well, Voyager actually has a surprisingly deep moat for a company losing this much money. First off, they have really deep NASA partnerships, specifically funding through a Space Act agreement for that Starlab program. Second, they own proprietary solid-state propulsion tech, but their absolute biggest moat? Switching costs. The U.S. military relies heavily on Voyager's technology. For the government to rip out Voyager's communication systems and replace them with the competitors, it would be like trying to change the engine of a car while you're driving 70 miles an hour down the highway. The customers would scream to leave. And that stickiness, that is highly valuable.
Section 4. Reading between the lines.
What's really fascinating here is what management is quietly admitting in the MD&A, the Management's Discussion and Analysis section. This is where we read between the lines to see if the executives are being totally straight with shareholders, and they drop this massive hint on page 49. Quote, "We will need to raise additional funds to meet our long-term strategic plans," and they state very clearly there's no assurance they'll actually be successful. This is management fully owning the reality. Despite having $429 million in the bank today, they know their Starlab Ocean Hotel is going to cost way more than what they have. They are actively signaling to Wall Street that a capital raise is coming. And remember, raising capital means either taking on more debt or issuing more shares, which waters down current owners.
So the crucial point we're left with is this incredible narrative tension. Can they raise cash before the lights go out? Voyager isn't just a business right now, it's a race. It is a high-stakes sprint between achieving their massive Starlab vision and running completely out of financial runway.
Section 5. Red flags and the bottom line.
Let's bring this explainer home by looking at the red flags. Look, corporate lawyers write these filings to cover everything from a slight supply chain delay to literal asteroid strikes. But let's separate that boilerplate legal filler from the immediate real-world risks draining this company's accounts right now. If we trace the exact steps of their cash drain trajectory, it looks like this. Step 1. They had $8.1 million in EAC adjustments. That's just accountant jargon for cost overruns on those fixed-price contracts we talked about. Step 2. Research and development expenses nearly doubled year over year to $7.5 million. And Step 3, the real heavy hitter. They spent $37.8 million in capital expenditures strictly on the Starlab space station. The money is just vanishing into future tech long before it can reach the bottom line today.
So, what is our verdict? Voyager Technologies is a high-risk, high-burn tortoise. They have an incredibly sticky defense business that gives them a really solid foundation, but they are desperately trying to build the future of space infrastructure before their cash runway ends. Next quarter, you need to watch two things closely. First, are they fixing their profit margins on those fixed-price government contracts? And second, when and how are they going to raise that new cash they admitted they need? That is your EDGAR brief on Voyager Technologies. Remember, this was a translation, not a recommendation. Go read the original 10Q on sec.gov if your interest is piqued. Thanks for hanging out with us at the EDGAR brief. But before you go, I want to leave you with this to ponder. If a company's greatest project burns cash for years before making a single dime, at what point does a visionary idea simply become a financial black hole? Think about it. See you in the next filing.